Hello and welcome to today's webinar, Redundancy, How to Secure Your Financial Future. My name is Krupesh Katecha and I'm a financial planner at Balanced Wealth Planning, and I'll be taking you through our guide to everything you should be considering from a financial perspective when you're faced with redundancy or you're negotiating a leaving settlement. In today's session, we're going to talk first about how to stay positive when you're being made redundant or negotiating leaving terms. We'll go through how to adjust to your new situation and plan ahead for the first few months and beyond. We'll then spend some time looking at the detail of how redundancy and leaving packages are usually calculated and structured, including how they're taxed. And then we'll touch on some of the most common financial planning steps we recommend. We'll also give you some actions to take away at the end. So let's get started. When you first learn that you might be made redundant or have to leave, it can be a huge shock. Our role at work is such a big part of our lives. For most of us, at work we are challenged and sometimes put under pressure, but it often brings a sense of achievement and satisfaction. It's where we learn new skills, develop good friendships, and of course earn the money that we need. What often happens when the bad news breaks is to feel a sense of shock, which can quickly develop into denial. A feeling that this can't be happening to me. As the realization sinks in, you can become frustrated with your lack of control over the situation and even angry or miserable. Your mood and belief in yourself drops and it's difficult to think about the future. But there has to be a turning point, and gradually you start to accept and engage with the new situation. And perhaps, to your surprise, you find there are some positives, maybe even some opportunities. You might find that this new situation forced upon you has actually done you a favour and helped you to take a step you would never otherwise thought of. It's important to remember through all this that it is not a criticism of you as a person. It's your role in the organisation that can't be supported anymore. It's not your fault. Your confidence might take a big knock, but you still have all the same skills, expertise and experience you had before. Just because you may not be contributing financially to the family or household for a while, doesn't mean that anyone will be thinking any less of you. You now have an opportunity to choose what to do next and how you'll be putting all your skills and experience to good use. Most likely, the main thing you'll be worrying about to start with, if you are in this situation, is how you're going to survive financially. To tackle that, you need a clear financial plan for the short term that you can stick to. Here are the 4 key areas to look at. The first step I always recommend is to identify what income you'll have after you've left work, assuming you don't have a new role lined up immediately. Your change in circumstances means that you could be eligible for certain state benefits, the main one being universal credit. For an idea of what you could apply for, check an online benefits calculator. But be aware that the benefits system is complex, and I think it's much better to make sure you've got a robust plan under your control rather than relying on benefits. If you will be eligible for benefits, you can look at these as the icing on the cake. Secondly, look at your spending for the last 3 months to get a good understanding of just how much your essential outgoings are each month, such as mortgage repayments, utility bills, or vehicle running costs. What are your other normal outgoings? Write absolutely everything down. We all spend more than we realise. Scrutinise your list, deciding what is essential and what is not. Where can you make savings realistically that you can sustain? Maybe the subscription for the gym you never go to, or the TV package you hardly use, for example. And then go through the payments you'd be prepared to stop in the short term while you get yourself sorted out. That could be anything from cutting back on regular dinners out and weekends away, to the regular investments to your children's junior ISAs or your own pension contributions. Remember, this is a short-term step until life settles down again. Thirdly, take a look at what you have in savings and investments that you could access at short notice. If you're over 55, you could look at your pensions too, because many can be accessed from that age. Don't forget to take into account any package or settlement you'll be receiving. How much do you have? How long would it last if you needed to live off it for a while? What would you use first? Lastly, go through your insurance policies. Look for any payment protection or mortgage protection insurance policies, which may be attached to any loans, credit cards or mortgages. Also check if you have any accident, sickness and unemployment policies in place. Now is the time to contact the insurance companies and tell them you need to make a claim. Be prepared to give them evidence and check with them what their waiting period is. Most plans have a minimum waiting period before they will pay any income out, but once payments start, they will pay you an income for up to 2 years or until you return to paid work. From all of this, you'll see whether you have enough money to support you and your family right now and what you need to change to get by in the short term. Most people who have been employed with the same company for a while become comfortable in that position. While it may not be an ideal job, natural human inertia stops us from taking any action to change things. Being made redundant could be the catalyst to making a change for the better. Just put financial considerations to one side for a moment and think about what you would do in the next 5, 10 or 20 years if you had all the money you needed and never needed to work again. What would you do with your life if you were in your current situation and were told you only had 5 to 10 years left to live? What would you prioritise? Is there any possibility that could happen with the wealth you currently have? Depending on your answers, you might be considering a new job doing much the same thing, or you might want to have a change in career and pursue a role that you would find more fulfilling than the one you had just left. Another option may be to start your own business and do something that you had always dreamed of. Is this the opportunity you've been waiting for? Or, depending on your settlement, your overall wealth and your age, you may be in a position to be able to stop paid work altogether if you want to. Working with a professional financial planner to explore all these options can be valuable for 2 reasons. Firstly, a professional planner can show you a forecast over your wealth now and over your lifetime, as you can see on the screen. And this can be based on a number of different scenarios. Seeing a wealth forecast in front of you based on you getting another job, investing in a new venture or stopping work altogether can be hugely empowering and allow you to really see what's possible and affordable. Professionals tend to use bespoke tools to forecast wealth and test out different scenarios easily. It's not impossible to do on your own to get a rough idea, but it's certainly a lot more challenging. Secondly, it can be difficult to think about what you really want in life and value. It's not something we naturally think about very often, and nor do we usually have the luxury of someone listening to us who is interested in exploring things with you. We are proud to see our professional planners are trained in helping you to do just that. Let's change direction now and look at what you might receive if you're facing redundancy. To receive statutory redundancy pay, which is a legal right, you must have been working for your current employer for 2 years or more. You'll be entitled to pay dependent on how long you were working there and how old you are. If you were made redundant after 6th of April 2020, your weekly pay is capped and the maximum redundancy pay you can get is £16,140. But some employment contracts are more generous than this. If you're not being made redundant, but you're negotiating a leaving settlement, it's common to agree anything from 3 to 18 months pay plus unused holidays and benefits. The amount will depend on your notice period and salary, among other things. Please note, due to the current pandemic, the government has put into place temporary business support measures, including the Coronavirus Job Retention Scheme. This differs to statutory redundancy as explained above. The first £30,000 of any settlement is usually tax-free. Any redundancy pay above £30,000 is usually added to any other income for that tax year and will be subject to income tax and national insurance. Other earnings are generally taxed as earnings including holiday pay, unpaid wages, bonuses and overtime. The tax can be significant if you're receiving a large amount. We'll be touching on how that works and how to reduce it in a moment. Your employer should deduct any tax for you, but there is a chance they won't have taken off the right amount. This isn't their fault, it's because the tax system is based on the assumption that we all get paid roughly the same amount every month. When there is a large payment in a month, HMRC systems think that you're going to receive that every month. That usually means you are going into a higher tax bracket and having more tax deducted incorrectly, but everyone's situation is different. The good news is that any tax overpayments can be reclaimed by contacting HMRC directly and explaining the situation to them, or by completing a self-assessment tax return. You can do that yourself or ask an accountant to do it for you. Bear in mind that there is also a chance that the tax deducted could be too little. It's up to you to notify HM Revenue and Customs if you think that's the case, and be aware that you might be asked to complete a self-assessment tax return at the end of the tax year to pay any additional tax due. I recommend trying to get a good idea of what you'll receive after tax on your settlement. That way, you'll be avoiding any nasty shocks or disappointments. Your employer may be prepared to help you with this. Don't forget that any non-cash benefits that form part of your redundancy package, such as a company car, will be given a cash value and will be taxed accordingly. Reducing the tax burden. The most common method of reducing income tax when you're receiving a large settlement is by using pension contributions. But before you put a large contribution into your pension plan, think about a few important points. Firstly, make sure that you keep back enough cash within an easily accessible account as a cash buffer. Once money has been paid into a pension, it can't be drawn back out unless you're over 55. Also, tax and pensions can be complex, and there are limits on how much you can pay in and still receive tax relief. So it's a very good idea to get help from a qualified independent financial planner to make sure you don't exceed the lifetime and annual pension allowances. You make pension contributions in order to benefit from the tax relief, so you want to be sure to get it. Then think about the timing. If you've received a large settlement, you will almost certainly want to make a pension contribution in the tax year you receive the payment to get the most tax relief possible. If you're still at work and haven't received a settlement yet, you may be able to ask your employer to sacrifice some of that money to put straight into a pension. The benefit of doing that is that you also save on national insurance as well as getting the tax back, but the employer needs to agree to it. You should also check for any initial charges that might apply to your pension before you pay anything in. Most modern pensions don't charge anything for new contributions, but some older ones, and even some available now from large companies, can be expensive with initial charges of up to 5% or tie-in periods. You don't want to waste your money that way, and there's just no need to be paying those charges. But once the money's gone, you can't change your mind. So ask your pension provider before you do anything, or talk to an independent financial planner like us to get advice. If a pension is not right for you, or you're limited in what you can pay in, then there are other options which are tax efficient. An independent financial planner can help you with this, and this is the sort of thing we often explore with our clients. ISAs are also a good starting point because they are tax efficient too. But it's important to think about what the money will be used for. If you don't need it, investing might well be a good idea for you. If you're likely to need it, or if you're not sure, the best thing to do is usually put it in a savings account with the bank, being careful not to put more than £85,000 in each account. If you think you might need to live off that money for a while, you'll have easy access. And if you think you might need it for a project or venture, you can keep the money in cash for a while and wait till that happens and see what you have left at the end. Many employers provide their employees with valuable additional benefits such as death in service life cover, private medical insurance and a company car, as well as others which you will lose when you leave. If you don't have a job lined up with similar benefits, you might want to arrange replacements yourself. You might want to take out your own life cover and private medical insurance, for example. You might also need to buy a new car. You want to ensure that your family is protected if the worst happens, but you will need to be comfortable that you can pay for it. Before you go and set up some life insurance policies, just be aware that there are several different types. It's particularly helpful to do this through a financial planner because you can have access to policies that you can't find yourself for the same cost or less. Also, a financial planner can help you work out how much cover you actually need. You might need more cover than you originally thought. Equally, it might be that you need less, or perhaps you don't need any cover at all. If you've worked for a big company, you might have share options of different types, or shares in a share save scheme or employee share ownership plan. They can be quite confusing with different categories of shares and complex tax treatment. You'll have limited time to exercise any options, usually 6 to 12 months, and if you don't exercise them, you lose the options. But before you rush to exercise them, check whether the option price is actually attractive. It often will be, but that's not always the case, so take care not to make a mistake that can't be undone. You might also have shares in the company, and you'll need to decide whether you want to keep them or not. The choice is yours, but be aware of the tax that could apply if you sell them. Depending on how the shares have been accumulated, there could be income tax or capital gains tax to pay. There are solutions that a professional can help you with to minimise tax, so speak to someone like us or a tax advisor before you do anything. You are likely to have a pension plan that you've accumulated with your old employer. It is important that you review your pension options and take independent financial planning advice. You'll have several options available, including leaving your pension where it is, transferring the money to a new employer's plan, transferring the money to a personal pension plan, or if you're over 55, you might want to start drawing out pension income. If you have a defined benefit pension, you'll be told what your pension is worth when you leave, which will be expressed as a pension income that you've built up until the date of your leaving. You'll be able to keep that until you retire, or you can ask for a transfer value, which is usually anything between 20 to 40 times the amount of pension, which you can move into a personal pension. This is a seriously complex area, and you shouldn't rush into a decision either way in that regard. If you do want to explore what to do with your defined benefit pension, speak to us. We have a team of pension transfer specialists and are always happy to help. While some people will be looking for a new role or perhaps retiring altogether, you might be thinking about something different. Have you always wanted to start your own business? There is a wide range of support available to startups ranging from local chambers of commerce to specialised business consultants. A well thought out business plan is an important ingredient for success. Spend some time thinking about how much you would need to get your business off the ground. A professional financial planner can use lifetime wealth forecasting tools and techniques to show you different scenarios, which all helps with the decision-making process. We define financial planning as an ongoing process to help you make sensible decisions about money and to give you the best chance of achieving your goals in life. What I particularly want to emphasize is that financial planning is not primarily about money. First and foremost, it's about life and what you want to get out of it. I've mentioned a few times that for many people it makes sense to work with a professional independent financial planner, and I want to explore a little bit about why. Now I want to emphasize there are very many people who describe themselves as financial planners but actually do quite different things from one another. Quite a few will fix specific problems but not look at the big picture, for example, setting up a pension plan. Many of them will use expensive investment portfolios, and some may even be restricted in some ways as to what they can do for you. Typically, they will have a limited range of investments that they will recommend to you, and they will usually not be prepared to give you advice about wider tax planning, for example, despite the fact that it makes such an enormous difference to your overall position. It's also very unusual to find a financial advisor to look at your lifetime wealth position and to think about how you can protect yourself if things go wrong. Lastly, most financial planning companies will charge a percentage of the investments they manage for you. We don't do that because we believe that approach would mean we are conflicted in how we could advise you. If you think of your life as being a long journey, look for someone who could advise you about your whole position. Would you work with a company that only sold their own brand walking boots and wasn't interested in where you were going in them, and the cost depended on your shoe size? Far better to work with an expert who can put together the whole package of things you need, the best boots, equipment, and so on. Luckily, that's exactly how we work. If you're thinking of looking for a financial planner and want to compare what they do with how we work, here are some suggested questions you can use. So, we have touched on how you are likely to feel if you're faced with a sudden departure from work and some of the key things to consider. Here's a summary of the practical steps you can follow now if you're in this situation. We are reaching the end of the webinar now, and I hope there have been a few tips and ideas in here that have got you thinking. There's no substitute for a good conversation with an expert, and I would like to invite you to arrange a free meeting with us should you wish. You can do that by phoning us or going through the online meeting booking tool on our website. The details are on the following slide. Here are some of our details. I'd just like to recap that we are a chartered financial planning firm. We are holistic financial planning specialists, which means that we are particularly good at working with people going through a period of change. If you'd like to know more, please contact us at team@balancewealth.uk or on 0800 772 3456, and we'll be glad to speak to you. Thank you.